What's going on, everybody? It's your boy drewiq. Welcome to another episode of Winners Win. Today we're going to be talking about tax loss harvesting. What is it? Everything you need to know. So please, like, subscribe. Please leave a comment below for any future video ideas, or if you just want to say hi. I do read all the comments. But yeah, let's go ahead and get right into the video, guys. Alright, so tax loss harvesting, what is it? Basically, this is a money move that you need to make before December 31st of every year, that the government is going to save you money on your realized losses on your investments. And what does it mean to have a realized loss? Now, whenever you buy a share of stock in a company, you will not have to pay any taxes until you sell that share of stock. So, whenever you actually sell, this is whenever you actually know if it's a realized gain or a realized loss. Now, simply, a realized gain is, did you make money when you sold that share of stock, right? Did you buy at a lower price and you sold at a higher price, so you made a realized gain of whatever amount of money you made, right? Or is it a realized loss? Did you buy this share and did it go down and you sold it at a loss, a realized loss? Now, once you understand what a realized gain is and what a realized loss is, now we can start going into this a little bit deeper. But that's the first thing we need to learn here, right? Now, tax harvesting is essentially something that we're going to be doing in your stock portfolio and not a Roth or an IRA account. So this does not apply to retirement accounts. So if you have a Roth or you have an IRA account and you're investing into stocks, you're buying and selling, you have realized gains, realized losses, but it's a retirement account. The whole point of a Roth IRA is that you do not pay taxes on any of that money. So this only applies to brokerage accounts, like if you have a Robinhood, Webull, you have a Charles Schwab, you have a TD Ameritrade, and it's a brokerage account where you're buying and selling shares of stock, and it's not within a Roth IRA or any type of retirement account. Alright, so before I give y'all an example, you really need to understand what is a capital gains tax, or a long-term capital gains tax versus a short-term capital gains tax, right? And a capital gain is basically whenever you buy a share of stock, it goes up in price, and you sell it, was it a year later or was it less than a year? Because that's really what makes a long-term capital gains tax, is did you buy this share of stock, hold it for at least 1 year, and then sell it, or is this going to be a short-term capital gains tax, basically less than 1 year, you bought and you sold, the next week, right? So the reason why this is important, because you're going to get taxed at a different rate. And this is actually one of the really main drivers for me choosing to be a long-term buy and holding investor. I like to buy stock and I like to hold them for typically 5, 10, 15 years before I sell them. At least 1 year though, so we can take advantage of the long-term capital gains tax. And the reason why this is important is because if you buy this share of stock for that 1 year and then sell it, it's taxed at a different rate. It's no longer taxed at your earned income. So, for example, if I buy, this share of stock, hold it for a year, it's going to be getting taxed at the long-term capital gains tax rate, which is at a 15%, instead of my earned income rate, which could be, let's say, 25%. Typically, it's going to be a lot higher, okay? Now, the only way you can get the, 0%, so you can actually pay no taxes on a long-term capital gains, but that's going to be only for people that make less than $52,000, and if you're married, $104,000. So let's not get into that. Basically, you just need to know what is a long-term capital gains tax, and if you buy a share of stock and you hold it for at least 1 year, then it's going to get taxed at a different rate than your earned income. It's going to be getting taxed at 15% instead of the higher rate, like 25%, which could be your earned income, and that could be your tax bracket. Anyways, I just wanted to make sure we explain that before moving forward and we start giving y'all examples and start doing some calculations. Now let's start, by giving y'all specific examples where we can apply our knowledge and really look at what a tax loss harvest is now that we understand how taxes work a little bit here and we have a little more background. Alright, let's get into it. Alright, so now that we know a little bit of the basics here, we know what capital gains tax is, we know that you actually get taxed on stock only when you sell the stock and it becomes a realized gain or a realized loss. Now we can actually talk about tax loss harvesting at a high level. So let's go ahead and let's look at this from one example. The most common example, in my opinion, is going to be, let's say, person A. Okay, this person is someone who typically just bought and sold shares, more like a trader, you know. So anyways, this guy, let's say at the end of the year, he bought some Microsoft stock he did really well on, and he got $1,000 realized gain. And you know, over time, maybe he bought some Grubhub, for example. He was a big fan of the Grubhub company. He thought that they were going to skyrocket, but he ended up buying them and they tanked. And he ended up selling it for a realized loss of $500. So overview, person A has $1,000 in actual realized gains and he has $500 in realized losses. Now in this scenario, what you would use tax loss harvesting for is that he would use that $500 to offset his gains. Now before we do that, I want to talk about typically what a basic scenario would be if he only had his gains and we taxed his gains. So if we didn't do tax loss harvesting at all, what would happen is he would take his $1,000 and let's say he's in the 25% tax bracket, he would have to pay 25% of that $1,000, which is $250. So he would have to pay $250 of taxes on $1,000 of realized gains, right? Now, let's think about this a different way, and we actually use tax loss harvesting. So, what we can do with tax loss harvesting is, before the IRS taxes us on that $1,000 of our realized gains, we're going to offset it by taking $500 of our losses and minus it from that $1,000, so it only looks like $500 of gains from the IRS's perspective. So they're only going to tax us, if we're in the 25% bracket, $125 off of $500 because we use the tax loss harvesting method and we took that $500 loss and offsetted that $1,000. Okay, I know that was a lot. You might have to replay this a couple times, but I hope that makes sense, right? If we didn't use tax loss harvesting, we had $1,000, we would have to pay $250 in taxes. If we use tax loss harvesting and we use $500 loss that we have, then we can use that $500 loss, offset that $1,000, so we're only taxed on half of it, which means we will only be paying $125 in taxes instead of that $250. So it is kind of a big deal, right? This is the number one most common way that I think a lot of investors will use tax loss harvesting. It's going to be more of a way to balance out your portfolio at the end of every year, but also take advantage of paying less in taxes while rebalancing your portfolio and selling some positions that you don't really like, but you could take advantage of those, you know, tax advantages. But yeah, so that's going to be the first scenario, the most common scenario, why a lot of people use tax loss harvesting. But yeah, let's go ahead and talk about, you know, the second scenario that I will see a lot of people come across. Alright guys, so the second example we're going to give here is going to be someone more from my perspective, someone who is a buy and hold investor long term. So maybe someone this year, they didn't even sell any shares of their stock, so they do not have any actual realized gains, right? So they have $0 when it comes to realized gains, but maybe they sold some of their positions and they have, you know, a realized loss of $5,000, for example. So how can they take advantage of tax loss harvesting when you can't use your loss to offset your gains because you don't have any gains? Well, something else that you can do here is that you can take a maximum of $3,000 from your losses and you can put that towards your actual income from your employer, your earned income. And you can only do $3,000 of that for your income. Now, if we take $3,000 and we use that towards our income to pay less in taxes over there, what happens is that $3,000 at a 25% tax bracket is going to actually be $750 that we save, just based off, taking that loss and actually using it on our income instead. We can save a pretty good amount on taxes that way. But we still have, if you think about it, if we had $5,000 loss, we take that $3,000 and put it to our income, we still have $2,000. What can we do with that? Well, what you can do is that you can actually carry over the next year and use that $2,000 the next year to save on taxes. Okay? So that is the second scenario, which you would see every now and then more for like long-term holders like myself. But yeah, those are the two scenarios whenever tax loss harvesting is going to come into play. And from my experience, like I said, I use it more of a way to take advantage and pay less taxes at the end of each year whenever I want to actually rebalance my portfolio, sell out on positions that I'm not happy with, and like I said, just take advantage of not paying as much taxes and really utilizing this tool as much as possible. I know there's a lot of services out there like Betterment, Wealthfront. They have digital, basically a guy behind the scenes that will do the tax loss harvesting for you and pretty much manage your portfolio for you. It makes everything really easy. So yeah, there's a lot of services out there that do it. You can have CPAs, a professional guy that is dedicated to you that will make sure that he's taking advantage of the tax loss harvesting if possible and stuff like that. Basically, we're just going to talk about what it is. You need to be aware of it. And in my opinion, this is something that you do need to be taking advantage of, or at least talk to your CPA with. Alright, so something that's also really important to think about is the wash loss rule. And basically this rule talks about if you are going to claim this tax loss harvest on one of these shares of stocks or one of your losses, you can't rebuy that same stock 30 days, within 30-day window, okay? So you're going to claim this loss at the end of the year, right, December 30th, and then you try to rebuy, January 5th. It's not at least 30 days, so it's just not allowed and you can't claim that loss anymore. Okay, so this is very important to understand. You have to have at least 30 days in between if you want to rebuy into that stock if you are going to claim it as a loss and use it on the tax loss harvesting tool here. So real quick, just wanted to give that tidbit. You need to at least have 30 days in between if you want to rebuy that stock that you sold as a loss for the tax loss harvesting to actually come into play here. Yeah. Alright guys, but that's going to be it for the video. I hope this was very informative for y'all. I know this was something that I learned within the last 2 years that I thought was very interesting. I wanted to share it to you guys. But yeah, like, subscribe, leave a comment below for any future video ideas or something. I know a lot of you guys have questions, so please ask your questions below, and who knows, I might make an entire video about it. Alright, but that's it guys. I'm out of here. Y'all have a great day, and thanks for stopping by.